First up, spotting the next superstar fund manager is becoming harder than ever to do. If research from overseas is to be believed, Credit Suisse's head of global investment strategy and renowned financial author Michael Maubossin says that the difference in returns between the best big investors and the worst has steadily declined over the last 50 years. So is this the case in South Africa? And Kabit Alatzalza joins us to answer the question.
Thanks for being with us here tonight, Anne. We've obviously seen this, discussing this article around Michael Maubossin and what he's talking about, the difference in performance between the top investment managers and the bottom investment managers. That's obviously research he's compiled overseas. I just wanted to get your impression and understanding of it here. The days of seeing large differences in alpha, that outperformance between top investment managers and the others, the rest locally, is that something you're seeing declining over the years in South Africa?
Actually, I'm not, but I think what he's looking at is maybe a different phenomenon than what he's identified. What I have identified in South Africa, and I think this is what's going on elsewhere in the world, is people are becoming better fund managers, not because they're more skillful, but because they understand more about what it demands to be a good fiduciary, to manage to a mandate, to have benchmarks, to have risk parameters relative to that benchmark. And I think as those requirements have become tighter and tighter, and as we've had more regulatory constraints in terms of forcing you to hold diversified funds and forcing you to hold, responsible funds, that probably is a phenomenon that he's picking up that's creating the tighter band of performances around managers. Because I don't think you're seeing it, say, in the hedge fund space where you don't have those, where you have those constraints.
So essentially what you're saying is the regulations actually acting as a moderator in terms of the ability of a fund manager to find out performance.
It's not just regulations. It's the recognition that in order to understand whether you actually have skill, you have to have a proper way to measure that skill against. You can't just sort of say, I have skill in hyperspace. You have to say, here's the market, this is what the market is represented by, and let's say it's an index or a benchmark that's appropriate to your fund. And can I outperform that? And so just forcing a manager to start thinking about how they're taking bets relative to some yardstick, starts to pull in the outliers in terms of manager performances and pulls in the way a manager actually starts behaving. Does that make sense to you?
It does, yes. So essentially you're removing some of the extremes by certain things, like when we talk about the regulation about being responsible fiduciaries, making sure that you run a proper investment portfolio, even the qualifications around the individuals that can get access to licenses to operate investment firms. That's essentially getting really at the tail end of the results spectrum, removing that, and you're getting more of the herd in the middle, essentially.
So I wouldn't just sort of say, oh, it's regulations that's created the problem. It's also being a good fiduciary.
We've got you mentioned the situation, you're still seeing large degrees of outperformance. Is it still as easy in South Africa? I mean, we were talking about this the other day off air. The number of stocks that we had on the JSE a few years ago was in the mid 500s. Now we're down to about 300 and something. The market's very concentrated towards the top as well. Is it becoming easier for fund managers to outperform their indexes, say, for instance, in the equity space?
Well, just take a look at the evidence. Everybody's been underperforming like mad in South Africa. We've had a huge period of underperformance from active managers. So I don't think that's quite the issue, that it's getting easier. But I think what people fail to understand is that when managers outperform or underperform, that often has to do much more with the market structure at the particular point in time than it has to do with manager skill. So when you get a situation where the market gets very, very concentrated, the performance is only being driven by a handful of shares, and you can't hold a diversified portfolio with just a handful of shares, then that kind of condition makes it almost impossible for any kind of regulated manager to outperform. I think of periods like 1999, where we just had 2 or 3 resource shares that were just going through the roof, but the rest of the market was actually underperforming. And active managers underperformed in that environment. So you've kind of had a history here in South Africa that if resources outperformed, active managers underperformed. But the last year we saw the reversal of that. Because what happened? Active managers in South Africa became value managers over time, That's a great strategy to adhere to. Value meant resources shares, undervalued. Everybody went piling into resources shares. Foreign investors came in and bought up the retail companies and the consumer shares and pulled the market up in that small segment. This market stayed down here. And guess who looks like a terribly bad manager? The South African asset manager. But this isn't so much of a skill issue, is it structure? And looking at opportunities that maybe will unlock themselves further down the road.
And we've kind of seen that. I mean, we were very focused at the beginning of the year with a lot of local investment managers saying that retailers were simply too expensive, they weren't getting involved. And obviously retailers have been driving, up to the early part, the first quarter of the year, had been driving the performance. So very much structure. But this again takes us back to how long is a track record a track record? Because we talk about these periods of dislocation which can last years. I think of the last 4 or 5 years where the industrials have outperformed and left everyone behind. And if you haven't been in industrials and resources, then you probably would have been towards the bottom of those tables. So when you evaluate investment managers, what is a suitable track record, and can people rely on it?
My absolute favorite question. This is where I go absolutely ballistic, because this wonderful article you're referring to talks a lot about Bill Miller's record as an asset manager in the U.S. and how many years was it? Something like 11 out of 13 years that he's beaten the S&P 500. And Alan Walsh did a wonderful, wonderful study, and he said, is this in any way significant, the fact that somebody can outperform the index 11 out of 13 years? I mean, we had Tim Alsop here with that wonderful Rainmaker fund. Does it mean anything? And the answer is no, because what the law of small numbers will tell you is that we simply do not have enough information to have any kind of statistical significance in that information. There just isn't enough data. And yet we have huge amounts of money chasing around the market thinking that 3 years of performance, and I just did this test with a whole bunch of trustees from one of our big banks, financial experts. And I said, how many years would you give an active manager? What do you think the answer is?
3 years.
3 years. 3 years. It's a magic number. And I don't know where that number ever came from, except for human beings love threes. Threes seem to be significant in our pattern recognition. And the problem is that 3 years is probably just one part of a cycle. And Watson Wyatt did a wonderful study a number of years ago that said that even professional consultants who are supposed to know better about when to pick good managers or not do it almost perfectly. They wait for a fund manager to have 3 years of underperformance, sell them, then that manager their cycle starts to turn, and they buy the guy who's just done 3 years of outperformance, buy him, and he goes like that. So what are we looking at here? Are we looking at skill? No, you're looking at the manager's investment philosophy, which comes in waves. And we know that a value strategy has a big, long wave. We know that a growth strategy has a shorter wave. And we know a momentum strategy has an even shorter wave. So we're just picking up these waves of investment strategies, not manager skills. Are you still with me?
Yeah, which makes the job of a retail investor and or a financial advisor that much trickier. But Anna, just before we run out of time, I wanted to ask you, we have seen a massive migration of investment managers into the value philosophy, the value stable. What's happened to the growth stable, and is it a function of the markets that we've seen over the last 5 years that have led to that? Why are there very few growth managers left?
It's my great disappointment about South African asset managers, and I've been here for 20 some odd years, so I've watched the cycles. In 1999, top of the pops for the growth. Now we have the value managers. And the reason why it's a real travesty is because it doesn't give a good diversification option to good consultants or advisor. A good consultant or advisor shouldn't be giving you the top performing managers, because you won't know when that cycle turns, and you'll be caught down on the bottom of that thing, to the way the value managers are now. You want to have a couple of different strategies in there. And probably the answer isn't growth, because that's almost the reciprocal of value. Maybe momentum is a better strategy to add to it, but you want to have the opportunity to at least select some kind of diversified styles to put them together if you are going to do any diversification.